Good morning. Today we're going to begin chapter 4, which is the first chapter in unit number 2 in our book, and it's unit 2 starts with chapter 4 and 5. Chapter 4 is going to be looking at your various options for organizing business. In this chapter, we're going to look at 3 primary forms of business ownerships: the sole proprietorship, a partnership, and corporation. We'll look at the advantages and disadvantages of each. These are the 3 that are used most often in business, although we will talk about some other corporations: S corporation, limited liability corporation, and cooperative corporations. The next slide has a video on it that's discussing forms of an organization in a business. So make sure you watch this video. The next 2 slides are just going to give you an overview of the different types of corporations, partnerships, and sole proprietorships that make up the ownerships of each type of business. This slide just gives you the structure, the ownership, and the taxation liability, and how you would use this type of corporation if you were thinking about becoming that type of a corporation. Now, let's begin our discussion on the forms of ownership with the sole proprietorship. Businesses that are owned and operated by one individual are considered a sole proprietorship, and they really are the most common form of business organization within the United States. Many of these organizations focus on service rather than the manufacturing element, because the manufacturing element requires such a large sum of money. One thing you want to know is that a sole proprietor generally will employ fewer than 50 people. And again, they comprise nearly 3/4 of all U.S. companies. I found this one interesting when I was studying the chapter, where it said that women business owners are less likely to get access to credit. This slide just will give you an overview of the advantages and the disadvantages of becoming a sole proprietor, so that if you're thinking of owning your own business, these are some things that you would want to look at. Notice that some of the advantages are ease and cost of formation. You get to keep all the profits, and it is very flexible in control of the business. Taxes are paid only once, and one of the big advantages is that it can be dissolved easily. Some of the disadvantages, that it can be an unlimited liability, and we're going to talk about that later. You've got to have diverse skills, and then sometimes it's harder to get qualified employees, and you do pay a high taxation rate. Now, the next slide is also a video on sole proprietorship.
If you're the only owner in your business and haven't formed a business entity, then you are a sole proprietor. What this means is that there is no legal distinction between you and your business. You are one and the same. Not only are you your own boss, but there's no fee or process to form a sole proprietorship. All you have to do is start making sales. One thing that you will need, however, is a DBA, doing business as, if you want to use a trade name. This usually ranges between $10 and $100 depending on the county your business is located in. When it comes to tax responsibilities, if your business ends up owing more than $1,000 at year's end, the IRS requires you to make estimated quarterly tax payments in addition to your annual income tax return. Another nice aspect of sole proprietorships is that they don't have any ongoing maintenance implications or responsibilities to worry about. That said, one of the drawbacks of being a sole proprietor is that you have no protection. You are held personally liable for any debts and obligations your business should incur. This means your personal bank accounts and even your home residence can be used to satisfy these debts. But hey, At least you get to be your own boss, right?
This slide goes back to one of the others when it said that sole proprietorships had a hard time finding talented employees. And one of the reasons is because large corporations, they have better profits and more job opportunities that people are looking for. As a sole proprietor in a small business, you probably would not be able to match the wage and benefits offered by large corporations. And then also you're not going to be able to give them a chance of advancement like a big corporation would have. This slide is just giving you an overview of becoming an entrepreneur, and we will deal with entrepreneurs in the next unit. But one of the big advantages is that as a sole proprietor, he keeps his profit, but again, he is responsible for all of the financial risk and obligations. The next slide is a video on partnership.
Anytime two or more people run a business together for profit, it's an official partnership. In a partnership, each partner is considered to be one of the business's owners. Partnerships are generally pretty easy to set up. There is no fee or process to form a partnership. You just need a partner and to start making sales. You'll also need a DBA, doing business as, if you want to use a trade name. This usually ranges between $10 and $100 depending on the county your business is located in. And lastly, a partnership agreement is recommended in order to minimize conflict or confusion down the line, but not required. One of the advantages for being in a partnership is that you get to enjoy tax benefits, since the profits and losses of the business pass through to each of your personal income tax returns. Tax responsibilities include, in addition to your personal annual income tax return, you and your partner or partners are responsible for making estimated income and self-employment tax payments once a quarter. Additionally, the partnership itself will need to file an annual partnership return. Another nice aspect of partnerships is that they don't have any ongoing maintenance implications or responsibilities to worry about. Thankfully, partnerships are pretty easy to run because each partner is personally liable for the debts and obligations of the business. In other words, there is absolutely no protection for you should you get into a legal situation. So keep that in mind as you form your business together.
Now we're going to discuss partnerships. Partnerships is a form of a business organization where two or more persons they act as co-owners of a business for profits. And this is one way to minimize the disadvantages of being a sole proprietorship and to maximize the advantages of having more than one owner. They're typically a little larger than sole proprietorships, but not as big as corporations. We have several types of partnerships that we're looking at. A general partnership involves complete sharing in both management and the liability of the business. So everything is 50-50. A limited partnership has one general manager who assumes unlimited liability, and then at least one limited partner whose liability is limited to their investment in the business. And so what that means is the limited partner exists for risky investments where there's a chance of loss. That would be if we were going into business together and I wanted to be the general partner, I would have unlimited liability. You might assume being a limited partner and limit your liability to $100,000. So that is all that you're going to invest, and that is all that you can be held accountable for. No matter what type of partnership you go to, you must, in most states, have an article of partnership. and it's a legal document that sets forth the agreement between the partners, and it states what each partner's management role is, what their duty is, how the profits and losses of the partnership will be dissolved, and how a partner can leave the partnership. This slide just gives you the advantages and the disadvantages of being in a partnership. It is also easy to organize, very similar to that of a sole proprietorship. It does allow for swift decision making, and again, the regulations are not, government regulations are few. Some of the disadvantages, again, unlimited liability. All the partners are responsible for each other's partnership. It's difficult to sell a partnership interest. Distribution of profits can also be uneven. Partnership and taxes. Now, partnerships are considered quasi-taxable organization, which means the partnership does not pay taxes, but they do file a tax return providing information on the profits and how those profits were distributed. Partners then have to report their share of the profits and pay taxes on the income rate as individuals. This slide just gives you some keys to success in being business partners. The third form of business ownership that we're going to discuss is a corporation. Now, a corporation is a legal entity created by the state whose assets and liabilities are separate from its owners. A corporation is going to differ from a sole proprietorship and a partnership in that the assets and liabilities are separated from its owner. What that means is a corporation has its own assets and liabilities, and the owners are not legally bound to take care of those assets and and liabilities. A corporation has the rights and duties and powers just as if it was a person. A corporation can own and transfer property. A corporation can enter into contracts. They can sue and be sued in court, and it does account for the majority of all the U.S. sales and incomes. Not all corporations are large, such as Coca-Cola, IBM, Xerox. Some of them can be small if they have been incorporated. When we're looking at creating a corporation, the individuals that are creating the corporation are known as incorporators. Each state has its own specific procedures for called chartering the corporation, and they have to file legal articles of incorporation with the state, and then the state's going to issue a legal corporate charter to the company. And then once they've got this corporate charter, then owners establish bylaws, and they're going to elect a board of directors. The next video is entitled The Different Types of Corporations.
We're often asked here when someone is starting a new business what type of corporate entity they should use. And there's various types in Michigan. There's what's called an LLC, which is a limited liability company. There's a subchapter S corporation. There's a C corporation. And there's also general partnerships and limited partnerships. And then you could also have what's called a sole proprietorship with an assumed name. I believe strongly that even if you're a startup company and you're starting with minimal assets, you should always incorporate your business. The reasons for that is you want to be protected and have a separation between your personal assets and your business. You may think you're just starting and you don't want to spend money on an attorney, or you don't want to spend money on filing fees to incorporate a business, but it's really not that costly. The filing fees with the state of Michigan would be under $100. And a good attorney should be able to do this type of work for under $1,000. And those documents will protect you and your personal assets that you've worked so hard for, including your house and your car and your personal bank accounts, so that if for whatever reason things don't go well with your company, that those will be completely insulated and protected from any detrimental things that might happen to your company. What are the differences? A limited liability corporation has some flexibility. There's a document that goes along with it that's called an operating agreement that will dictate what the duties and responsibilities are of the various owners and how the company would be run. An LLC, as it's called, can be taxed either as a corporation or a partnership. The CPA that you use would most likely want to advise you what's more advantageous to you to be taxed as a partnership or a corporation. A Subchapter S corporation is similar to an LLC in that it has pass-through income to the individual owner. So the profits or losses from the corporation flow down to the individual, and that individual owner will receive what's called a K-1. A C corporation is taxed at the corporate level. So the losses or profits from the business do not flow down to the individual, and instead they're taxed at the corporate level. Sole proprietorship does not have those protections that I mentioned that I think are critical and important. And an assumed name is just a name that you register with the local county and the state of Michigan to operate your business as a sole proprietorship. These tax questions are critically important to business owners. The good news is they can be changed. So if your circumstances change in the future and your businesses grow, you may decide to switch from one type of corporation to another. And those are all things that we can do for you here and advise you and give you consultation on. At Resnick Law, we work for you. It's the client who hires a law firm, not the other way around.
This slide just gives you the advantages and disadvantages of a corporation. One of the biggest advantage, again, we've talked about it in the other two, they have unlimited liability, and a corporation has limited liability, meaning that if a corporation is sued, it cannot sue the owners. It can only sue the corporation. One of the big disadvantages is that it is double taxation. Whether or not if the owner is a corporation, he has to pay taxes on the corporation, and then he has to pay taxes on any money he's gotten out of that corporation. So let's talk about some of the different types of corporation. We're only going to hit on the major ones. If you're looking at becoming a corporation, make sure you do your research. We have a domestic corporation, and that is a corporation that conducts business in the state in which it is chartered. A foreign corporation is a corporation that does business outside the state in which it's chartered. And then an alien corporation would be a business that does conducts business outside the nation in which it's incorporated. If I'm not mistaken, Coca-Cola would fall under all of these because they do business in Georgia, they do business in other Alabama, all the other states, and then they also do business in foreign countries. A joint venture is a partnership that's established for a specific project for a limited time. Now, a joint venture can be, the control can be divided equally, or one partner can control all the decision making. Joint ventures are used generally for large investments such as the development of new products. An S corporation, it's a form of business ownership that is taxed as though it were a partnership with some restrictions on shareholders. What it does is it eliminates the double taxation, but it still retains that limited liability benefit. This is one corporation that you would want to consider if you are an entrepreneur, because it represents half of the corporate filings. Some other types of corporation is a limited liability company, LLC. Now, I advise my students that if they're going to go into business for themselves, they always either want to be an S corporation or they want it to be a limited liability company. It's a form of ownership that provides limited liability and taxation similar to that partnership, but it has fewer restriction. And it's considered to be a blend of the best characteristics of the corporation, the partnership, and the sole proprietorship. What it is if someone's going to sue you, they cannot take your personal property. They can only take anything that belongs to the company. And then you have cooperatives, or what is called co-ops. And this is just an organization that can be composed of individual people or small businesses that have banded together to reap the benefits. It's set up not to make money as an entity, but so that members can become more profitable. A public corporation is a corporation whose stocks anyone can buy or sell or trade. Now, there are two types of public corporations. You have your quasi-public, which is owned and operated by the government. It does provide a service, but often operates at a loss. And then, of course, you have a nonprofit, which focuses on providing a service rather than making a profit, but it is not owned by the government. Most private and public corporations and nonprofit corporations have a board of directors. Now, that board of directors is charged with overseeing the general operation of the corporation, and it is generally elected by the stockholders. They set long-range objectives, their goals, and then they ensure that they're met, and they're met on time. Board members are really legally liable for the mismanagement of the firm or any misuse of the company funds. An important duty of the board of directors is to hire corporate officers, such as the president, the chief executive officer, the chief CFO, the chief financial officers. They are who's responsible for the directors are responsible for the management and daily operation of the company. Directors can be employees called inside director, or people unaffiliated with the company called outside directors. So inside directors would be those people within the company that your CEOs, your CFO that are running the company, and then outside directors could be your lawyers, your bankers, and even professors. So let's talk a minute about stocks and dividends. Corporations are owned by individuals or other business organization who have purchased shares of the business. Two ways you can have shares of a business. You can have stocks, and stocks are shares of that corporation that can be bought or sold or gifted or inherited. You can also get dividends from a corporation, and what that is there are profits that are distributed in the form of cash payments to stockholders. Not all corporations give dividends to their stockholders. They have the preemptive rights to actually hold those dividends and put them back into the business for capital expenditures and different things like that. The next slide is just a video on different
types. Common stocks are also generally more volatile than preferred stocks.
Now, as the video talked about, generally there are two types of stocks. You have a preferred stock and you have a common stock. Owners of a preferred stock are what they call special class of owners because they generally do not have any say in the running of the company, but they have claim to the profits before any other stockholders do. Other stockholders do not receive any dividends unless the preferred stockholders have already been paid. Such dividends unpaid from a previous year have to be paid to preferred stockholders and others before other stockholders can get their dividends. Common stock is when someone has voting rights. They don't get the preferential treatment with regard to dividends, but they do get some say in the operations of the corporations. They can vote by proxy, meaning they can have someone vote for them. Common stockholders in most states have preemptive rights to purchase new shares of stock from the corporation when a firm decides to sell them. Not all corporations, whether they're large or whether they're just a small corporation, are publicly traded. Some of them are considered a private corporation. And when you see a private corporation, it means that they're owned by just one or few people who are closely involved in managing the business. None of their stock is sold to the public, and they are not required to disclose financial information publicly. When a private corporation decides they want to go public, most of the time they do this in order to raise capital. Then they sell their corporation stock on the public market for the first time. That's considered an IPO, or an initial public offering. Now let's look at some things you will see within the business world. And unless you pay close attention and work in the business environment, you're not going to see this a lot or hear about it, because most of the time it's not done very out in the public a lot. The first one is we're going to talk about is a hostile takeover. And a hostile takeover is when one individual or a company attempts to buy a majority of the shares, the stocks within a company for the purpose of restructuring the management team or the board of directors. They may want to get rid of the management team or the board of directors, so they start a hostile takeover. Now, this is different from mergers and acquisitions because it's not a mutual agreement for the transfer of company ownership. Many times companies are vulnerable to hostile takeovers, will institute what they call a poison pill, which works to dilute the value of the company stock. That makes it less attractive for other individuals or companies to purchase the majorities of shares in that company. The poison pill can decrease the stock value, and so then the company just will back out because then they're getting no return on their investment. Another trend in business ownership is mergers. And a merger is when two companies, and generally it is corporations, come together to form a new company. You have the horizontal merger, and that's when firms that make and sell similar products decide, let's just merge together and combine our assets and then only have one product on the market. You also have a vertical merger, and that's where companies operate at a different level, but they're related in the levels of an industry merge. And then the last one is a conglomerate level merger, and it's just when firms in unrelated industries merge. Another trend in business management is the leveraged buyout, and that occurs when a group of investors borrow money to acquire a company or parts of one, and they're using assets of the purchased company to guarantee repayment of their loan. And this is called an LBO, a leveraged buyout. And in 1980 and the 1990s, LBOs, mergers, and acquisitions dominated the landscaping earning and the label merger mania. Some people see mergers and acquisitions as a positive force because they're going to boost stock prices and your market value, benefiting the stakeholders. But then on the other side, you have critics that argue that the mergers hurt companies because they force managers to focus their efforts to avoid takeovers rather than managing effectively. Some companies have had to take on heavy debt in order to starve off a takeover or a merger, and then it gets them go into bankruptcy. One thing I do know is when there is a leveraged buyout, people lose their jobs. And this was back in the early 2000s when a lot of the banks were going bankrupt and banks were being bought out or leveraged buyout from bigger banks, and the smaller banks, the hometown banks, they had to, when they were taken over by BB&T or one of the bigger groups, the people in that branch, a lot of them lost their jobs. So there's pros and cons on both sides of that. This slide just shows how Google has gone in and acquired different companies. And, if you look at Google's earnings, they're just unbelievably rich. These are just some of the other trends in corporate ownerships that you might hear about. Acquisition, and that's the purchase of one company by another. Corporate raider is generally a company or an individual who's in charge of to take over another company, and then what they do is they first offer to buy some or all of its stock at a premium in a tender offer. And then in one of the other slides, we talked about a poison pill, and the poison pill just allows stockholders to buy more shares of a stock at a lower price than what is shown on Dow Market or something like that. And what that does is it just tries to head off a hostile takeover. A shark repellent, that's when management acquires the large majority of stockholders to approve a takeover. And then, of course, your last one is you got your white knight, and that's the more acceptable firm that's willing to acquire a threatened company. And finally, we have some discussion questions that you can just kind of look at to review your chapter. And next is chapter 5. So hope you enjoyed chapter 4.